Hi everyone, this is Amit Jeswani, founder of StallionAsset.com. Cochin Shipyard is coming with an IPO. We believe the fair value of the stock is 575 per share. The IPO is fixed at 432, with retail getting 5% additional discount. Retail investors will get shares at $410. Now, you guys have an opportunity to make 40% a week. Now, let's understand how did we get the fair value of 575. The first thing, yesterday I attended a CFA conference where the speaker was mid-cap mogul Kenneth Angare, and his investment philosophy is pretty simple. If 80% of an industry is making losses, buy the 20% that are able to make profits, because when the cycle turns, these 20% profitable companies will go up 3, 4, 5x. Cochin Shipyard exactly fits that criteria, where most of his competitors are heavily debt-ridden, nearly bankrupt, but this company is holding very strong. The government has been divesting good profitable companies like Hutco 2 months back, now Cochin Shipyard. The best part about the deal is that the government prices these IPOs very cheaply, so we have a lot of alpha there. The grey market is very excited about this stock and pricing it at a premium of 145 per share. Now this is a listing gain of about 35-40% in a week. Retail investors will obviously get 5% additional. The company, now coming to the value, this is the most important part. You're paying 432 rupees a share. The cash on books per share is about 220 bucks. So effectively, the value that we are paying for the stake is 212 rupees per share. The EPS the company did in FY 2017 is 24 rupees per share. So the way we value this company at 15 times FY 17. This is very conservative, and we come to a price. The operating business is valued at 23.7 into 15 times, which is about 355 per share, plus 220 rupees of cash balance. So broadly, the valuation of the company is 575 per share. We believe the company can grow at 10% for the foreseeable future and can generate 15-16% ROE. Now, the first important factor is, let's understand the business of this company. Cochin Shipyard started in 1975, so it's broadly a 40-year-old company. The business can be divided into two main parts. Part one, and the more important part, the ship repair business. And the second part is the ship building business. As you see, the ship repair business is 26% of revenues in FY 2017, and it's growing at 38% over the last 2 years. Cochin Shipyard has 39% market share in the ship repair business in the country. So when we met the management during the IPO meet, the management said that the ship repair business makes 5 times more money than the shipbuilding business. So this business is very important, and this is where they have a very high market share. Now, if you see the market share of other players, Goa Shipyard has 20%. The other players are small, very small. So this is clear cut the leader in the market. Now, where they're going to invest the IPO money, which they're going to get? So they're going to get about 1,000 crores from IPO, and they already have about 2,000 crores of cash. So broadly, they'll have 3,000 crores of cash. They have planned out an expansion which will get completed in the next 3 years, and they are using the expansion for two things. One, a new shipbuilding facility, and the second one is a new ship repair facility. 85% of the total business Cochin Shipyard gets, they get from defense, that is the Navy and the Coast Guard. These are not cyclical businesses like demand nahi hai and all that. These are not the defense is very secular business, and they're not affected by economic cycles at all. So this is where this company stands, and that's the reason why other people cannot compete with this company, only because this company gets orders from defense. Now defense orders are long-term orders, and they're not affected by the economic cycle. So basically it's a recession-free business. Now let's look at the peers. Now when I look at this, I love this company too much. As I told you before, as Kenneth Angare said, I'll just repeat that. When 80% of the industry is struggling and 20% of the industry is doing well, buy the 20% industry. Now, this is exactly where this company comes in. Look at this. Look at the industry structure. Reliance Defense, EPS of -8. ABG Shipyard, EPS of -686. Negative book value. So this is the company which is extremely strong, very strong balance sheet, and is definitely not going bankrupt with this kind of balance sheet. Now, Warren Buffett speaks a lot about moats, and the biggest barrier to entry in this segment is obviously everyone else who has invested money in this segment is already bankrupt. Why put money when incumbent companies in themselves cannot make money, right? So there are high capital investments which are needed to start a dockyard, at least 2,000 crores. No one has 2,000 crores just to start a dockyard, just out of the blue. The technology that you need is very high end. Will you get defense orders? So there's not going to be any big capex happening. So we believe that there's a very strong moat this company has. Now, coming to the conclusion, Cochin Shipyard is a superb company. The bet is on Make in India. And as the government starts giving orders to these PSU companies for defense projects, and that is what this government's agenda has been, we can see strong order inflow for the next many years. So the 575 valuation which we have given is a very conservative valuation, and we are very confident that this stock is a compounder for a very long time. Great cash flows. So it's a strong subscribe from Stallion's point of view. Thank you, and please subscribe to our channel. We'll be adding a lot of interesting data going forward, and hope you like this video as well. Thank you.